Imagine standing on a street corner and you're looking at two completely different buildings.
Okay.
On your left, there's a massive, gritty industrial plant.
Right.
Smokestacks are churning, and they're pumping out tons of this highly engineered black powder used to manufacture car tires.
Yes, heavy industry.
Exactly. And then on your right, you've got a gleaming, hyper-modern glass office tower right in the heart of downtown Philadelphia.
It really is a study in absolute extremes. You are looking at the heavy, physical, global supply chain standing right next to the, hyper-localized luxury commercial real estate market.
Right. And on the surface, you would think industrial chemicals and Philly office suites have absolutely zero in common.
Oh, totally.
But welcome to our deep dive, because today we are taking you through two companies that just released their earnings reports, and they're writing the exact same corporate playbook.
It's fascinating.
We are looking at Cabot Corporation, which is a global specialty chemicals giant, reporting their Q1 2026, and Brandywine Realty Trust, an office real estate investment trust, reporting their Q4 2025.
And our mission for you today is to show you why these two radically different reports are actually a perfect mirror of the 2026 macroeconomy.
Okay, let's unpack this, because both of these are legacy companies.
Right.
Both are facing brutal structural headwinds in their traditional bread and butter markets.
Oh, absolutely brutal.
But neither of them are rolling over. Instead, they're executing a masterclass in how to survive, pivot, and, navigate an incredibly stormy economic transition.
What's really fascinating here is how these two reports highlight a broader theme of our current reality. We're going to look closely at how modern management teams use defensive liquidity, basically hoarding cash and slashing costs, to fund aggressive niche growth.
Yeah.
It's the ultimate balancing act, really. How do you protect the fortress while simultaneously building the future?
So let's start with the chemical giant, Cabot. I call this first part the trade war in the tire aisle.
That fits perfectly.
Cabot's traditional core business is reinforcement materials. And for anyone who isn't a chemical engineer, they make carbon black.
Which is incredibly important.
Right, because carbon black isn't just soot. It is a highly engineered material that bonds with rubber polymers at a molecular level.
Right.
Without it, a car tire would literally disintegrate after a few miles on the highway. It gives the tire its tensile strength and heat resistance.
It is the essential physical ingredient for global mobility. But despite how essential it is, Cabot's recent financials in this segment took a real hit.
Yeah, they did.
Their Q1 adjusted earnings per share came in at $1.53, which is down 13% year over year.
And if we look at the reinforcement segment specifically, their EBIT dropped by $28 million.
Ouch.
Yeah. Now, real quick, EBIT stands for earnings before interest and taxes. It's basically the operating profit they make just from manufacturing and selling their products before the accountants and the tax man get involved.
Right.
A $28 million drop in operating profit is a big deal, and the driver of that was a 15% volume drop in the Americas.
Which is huge.
Why are they suddenly selling so much less carbon black in their own backyard?
Well, the core issue driving that drop is the massive influx of Asian tires into Western markets.
Okay.
To give you the specific numbers, tire imports are up 4% year over year in the US, and they're up 8% in Europe.
Wow.
Meanwhile, if you look at a market like Brazil, they actually saw a 4% decline in passenger car tire imports recently.
Why the decline there?
Because the Brazilian government implemented protective tariffs on those imports.
Now, I want to pause here for a second just to be completely clear for you listening. We are looking at this strictly as an economics puzzle.
All right, absolutely.
Regardless of where anyone listening stands politically on free trade, protectionism, or international tariffs for a company like Cabot, this is just pure math.
Yes.
It's an objective reality that a massive influx of cheaper imported tires is completely disrupting their traditional sales landscape. We're not taking a stance, just reporting the facts of the market.
Exactly. We are just looking at how changing trade policies impact the bottom line. It's a change in the physical variables of their business.
Right.
If millions of finished tires are being imported from overseas, it means local tire manufacturing plants in the US and Europe are producing fewer tires.
Makes sense.
And if local plants are producing fewer tires, they need less carbon black from Cabot.
Wait, hold on. I need to challenge this because Cabot is a massive multi-billion-dollar global giant.
Yeah.
Why are they a victim to local geography? It's like a local bakery losing business because a massive mega chain is giving away cheap imported cakes across the street.
That's a great analogy.
If the tires are being manufactured over in Asia right now, why can't Cabot just load their carbon black onto a massive cargo ship and send it over there to meet the demand?
This raises an important question, and the answer comes down to the fundamental physics of the product itself.
Heck.
Cabot operates on what the industry calls a make region, sell region model. You cannot efficiently ship carbon black across the globe.
Why not? I mean, they ship everything else.
Think about what it is. It is an incredibly fluffy, low-density powder. Yeah. If you put it in a shipping container, you are essentially paying long-haul ocean freight rates to ship a box mostly full of air.
Oh, wow.
It's like trying to ship millions of bags of potato chips across the Pacific Ocean. The logistics simply do not make economic sense. The shipping costs would wipe out the entire profit margin.
Oh, wow. Okay, so they are physically trapped in their local geographies.
Yes.
They have to manufacture the chemical right next to the plant that is building the tire.
Precisely. Therefore, when cheap imports flood the U.S. and European markets, local tire production slows down.
Right.
In the Americas recently, tire industry utilization rates dipped below 80%.
Yeah.
And when utilization drops, the local pie shrinks.
And people start fighting over the slices.
Exactly. Competition for the remaining local business gets fierce. Cabot actually noted they faced a 7 to 9% decline in pricing during their recent annual contract negotiations.
So they are getting squeezed on price in their own backyard, and they can't export their way out of it because the product is too fluffy to ship.
That is the structural headwind they are dealing with.
Here's where it gets really interesting, though.
No.
Because while their legacy tire business is getting battered by global trade winds, Cabot has a hidden engine that is absolutely roaring.
They really do.
Let's look at their performance chemicals segment. While the legacy reinforcement segment was down, performance chemicals EBIT actually increased by 7%.
Right.
And the absolute star of the show here, their battery materials product line, which saw a massive 39% revenue growth.
39% is huge.
Yeah.
And the margins on that growth are stellar.
Real.
Yeah, this segment is operating at an incredibly attractive 22% trailing 12-month EBITDA margin.
Okay, let's translate that acronym for a second for the listener. EBITDA is earnings before interest, taxes, depreciation, and amortization.
Right.
Basically, it's a proxy for the cold, hard cash profit the business is generating from its operations before any fancy accounting tricks. A 22% cash margin in manufacturing is phenomenal.
It is. This isn't just revenue growth. It is highly, highly profitable growth.
And a huge catalyst for this is a multi-year agreement they just signed with PowerCo.
Yes.
If you aren't familiar with PowerCo, they're a subsidiary of the Volkswagen Group. VW is the second largest auto producer on the planet, and they're building out massive new gigafactories to produce their own electric vehicle batteries.
Right.
Cabot just cemented themselves right at the center of that next generation supply chain.
But if we connect this to the bigger picture, it goes far beyond just electric vehicles.
Oh.
Cabot's management extensively highlighted their growth in battery energy storage systems, or ESS.
Okay.
This sector is projected to grow at a 26% compound annual growth rate through the year 2030.
Wow, 26%.
And a massive, massive driver for that ESS demand is the incredible power requirement of AI-enabled data centers.
Okay, I have to stop you and push back on this because I want to make sure I understand the mechanics here.
Sure.
I totally get why an electric vehicle needs a highly engineered premium chemical battery. An EV battery has to be incredibly light. It has to discharge power incredibly fast to accelerate.
Right.
And it's hurtling down the highway at 70 miles an hour in freezing or boiling weather. But a data center battery, that's literally just a giant stationary box sitting in a warehouse somewhere. Are these stationary backup batteries really requiring the exact same premium high-margin chemical blends as a performance sports car?
It's a brilliant question. And what's fascinating here is the completely different, yet equally extreme engineering challenges that both applications face.
Okay.
You are absolutely right that electric vehicles are severely space constrained. They need extreme energy density.
Right.
You have to pack as much power into as small and light a box as possible to maximize the driving range. And Cabot provides specific advanced conductive additives to achieve that high energy density.
Right. That makes intuitive sense.
But a battery energy storage system for an AI data center faces a totally different physical hurdle. It is much less constrained by physical space. You could just build a bigger warehouse.
Yeah, exactly.
But it demands incredible cycle life and absolute flawless efficiency. Think about what an AI data center is doing. It's running billions of calculations a second, training massive language models.
Okay.
If that facility loses power for even a microsecond, an entire training run worth millions of dollars could be corrupted or lost.
Wait, a microsecond?
Yes, literally a microsecond. The backup batteries don't just sit there for years waiting for a blackout. They're constantly interacting with the grid, smoothing out power fluctuations, charging and discharging instantly to maintain perfect equilibrium.
Oh, I see.
They need to do this flawlessly over thousands and thousands of cycles without degrading. Cabot's advanced conductive additives and specialized carbon nanotube blends are critical for both use cases.
That is wild.
Yeah, they formulate the specific molecular glue that optimizes performance, whether you are solving for space constraints in a car or extreme cycle longevity in a server farm.
So they are effectively the picks and shovels of both the EV revolution and the AI data center boom.
Exactly.
The exact same company that is hurting because of cheap tire imports is quietly supplying the chemical backbone for artificial intelligence.
That's quite the pivot.
Which brings us perfectly to the core concept connecting our two companies today. Because this specific strategy, finding a high-margin premium lifeline while your legacy core business is under siege, isn't just happening in industrial chemicals.
No, it's not.
If you look at downtown Philadelphia right now, a real estate company is pulling the exact same survival lever.
We are making a sharp transition here from global specialty chemicals to hyper-local commercial real estate.
Yep.
Because just as Cabot is finding premium growth amidst a troubled tire market, Brandywine Realty Trust is finding premium growth inside a market that most of the financial world assumes is completely dead.
Commercial real estate, specifically office space, has been the subject of intense, almost apocalyptic pessimism since the pandemic.
Oh, absolutely.
Everyone assumes no one is ever going back to the office. But Brandywine's Q4 2025 results were universally described by analysts as better than feared.
Which is high praise in that sector right now.
Truly, their revenue beat expectations, coming in at roughly $120.95 million. Now, their GAAP net loss was 21 cents a share, which was actually a 2-cent beat against expectations, but, still a loss on paper.
However, the metric that actually matters for a real estate investment trust, or REIT, is not GAAP net income. The metric to watch is FFO funds from operations.
Let's explain why that is, because this trips a lot of people up. Why do we ignore net income for real estate?
Because under standard accounting rules, buildings are giant assets that must be depreciated over decades.
Right.
That depreciation is recorded as a massive expense on the income statement, which drags standard net income down, often into the negative. But the building isn't actually losing cash value every year in many cases. It's appreciating.
Right. Depreciation is just a paper loss for tax purposes. No cash is actually leaving the building.
Exactly. So FFO funds from operations adds that paper depreciation back into the equation.
Oh, wow.
FFO tells you the actual physical cash the building is generating to keep the lights on, service the debt, and pay dividends to shareholders.
And Brandywine's FFO was exactly in line with consensus at 8 cents a share.
Nice and steady.
Their core portfolio occupancy is holding remarkably solid at 88.3%, and it's over 90.4% leased.
Wow.
Even more surprising, their same-store net operating income actually grew. It was up 2.4% on an accrual basis and up 3.2% on a cash basis.
The management team's thesis for why they are not just surviving, but actually growing their operating income in a distressed market is a phenomenon they call the flight to quality.
Right, the flight to quality.
We are seeing a massive bifurcation in the office market right now.
What does that look like on the ground?
It means commodity office space.
Hmm?
Your standard boring fluorescent lit cubicle farms from the 1990s is dying. Companies are abandoning those lower tier buildings.
Right.
But those same companies are still willing to pay top dollar for premium, highly amenitized spaces.
Yeah.
If a CEO wants to lure remote workers back to the office, they can't offer them a gray cubicle. They need hospital-grade HVAC systems, integrated transit access, outdoor terraces, high-end fitness centers, and collaborative flex spaces.
It's basically like the broader office real estate market is a complete ghost town, just tumbleweeds blowing through the lobbies of B-tier buildings.
Yeah, exactly.
But Brandywine is operating the one luxury penthouse building in the center of town that somehow still has a waiting list.
That's exactly it. And Brandywine is leaning hard into this. They are actively consolidating their premium assets.
How so?
Well, for instance, they just fully bought out their joint venture partners in 2 prime Philadelphia properties.
Okay.
Specifically, 30225 JFK and 3151 Market Street, making those premium towers wholly owned.
Wow. They lease 157,000 square feet this quarter alone.
Yeah.
But here's my question for you, and it's a big one.
Go ahead.
Is leasing 157,000 square feet really enough to offset the massive crushing debt that commercial real estate companies carry in a high interest rate environment? I mean, are they actually making money, or are they just kicking the can down the road?
That is the critical lens to view this through. Look closely at their dividend. They are paying an 8-cent per share dividend to their investors.
Okay.
And as we just discussed, their FFO, their actual cash generated, was exactly 8 cents.
Wait, that is a 100% payout ratio? Every single penny of cash they generate is going straight out the door to maintain the dividend.
Precisely. So to answer your question, no, this is not a story of explosive earnings power or massive profit accumulation right now.
Right.
It is purely a story of operational stability and managing a brutal transition. The goal isn't immediate growth. The goal is liquidity preservation.
Just survive.
Exactly. They are generated just enough cash to cover their obligations, keep their lenders happy, and maintain their premium portfolio while the rest of the commodity market shakes out and goes bankrupt.
So what does this all mean? When you look at Cabot and Brandywine side by side, we're looking at the 2026 corporate survival playbook. The through line connecting global chemicals and local real estate is that both of these management teams are aggressively, ruthlessly pruning dead weight.
Oh, yeah.
They're protecting their balance sheets at all costs so they can survive long enough to pivot to the future.
The financial discipline on display is striking. Look at Cabot. They achieved $50 million in hard cost savings in 2025.
Wow.
They're targeting another $30 million in structural cost reductions for 2026 through headcount reductions and procurement efficiency.
And they slashed their capital expenditures too, right?
Yeah, by $60 million, bringing it down to the $200 to $230 million range.
And most notably, they are rationalizing, which is a polite corporate word for cutting their legacy carbon black capacity in the Americas and Europe.
Right.
But simultaneously, they are ramping up a newly acquired Bridgestone plant down in Mexico and bringing brand new production lines online in Indonesia.
And Brandywine is executing the exact same financial discipline with their properties.
Yeah.
On their earnings call, they made sure to highlight to investors that they have a $600 million untapped line of credit and absolutely zero bond maturities until November 2027.
So they basically bought themselves a runway.
They did. And they are targeting between $280 million to $300 million in asset sales for 2026.
Okay.
They are going to use the cash from selling off their non-core buildings to deleverage, reduce their overall debt burden, and recapitalize their development joint ventures down in Austin.
Wow.
Yeah, they guided their full year 2026 FFO to be between 51 and 59 cents.
But I have to push back on this broader strategy for both of them.
Okay.
Are these companies just shrinking to greatness? I mean, if you sell off $300 million in real estate or you permanently close chemical plants in Europe, aren't you just delaying the inevitable? You can't just cut your way to long-term growth, right?
If we connect this to the bigger picture, it's crucial to recognize the difference between shrinking and strategic reallocation.
Okay, unpack that.
Cabot isn't just closing plants to save a buck. They're shifting that capital entirely away from legacy Western tire markets that are under attack by imports.
Right.
Where are they putting it? They're moving it toward Mexican tire expansion because that's where the manufacturing is moving, and into high-margin global battery materials.
The picks and shovels for the AI boom.
Exactly. And Brandywine isn't just holding a desperate fire sale. They are systematically shedding their non-core lower-tier assets, specifically to pay down debt, so they can focus entirely on high-yield, premium Philadelphia properties that still command top dollar.
Yeah.
In both cases, across two completely different industries, we are seeing intense defensive discipline being used to fund offensive innovation.
It really is a masterclass in capital allocation.
Truly.
So, to wrap this up for you listening, whether you are dealing with the painfully slow return to office trends like Brandywine, or you're navigating a delayed tire replacement cycle and massive global trade tensions like Cabot, the rules of the game have fundamentally changed.
They have.
The winners in 2026 are clearly the companies that have the balance sheet liquidity to wait out the storm, and the premium, highly specialized products to command pricing power when no one else can.
It leads us with a rather profound shift in corporate strategy to consider.
What's that?
Think about it. For the last 20 years, the ultimate measure of corporate success was all about unchecked global expansion and maximum scale.
Right.
Bigger was always better. You wanted a sprawling footprint.
Sure.
But when you look at the protective tariffs, completely reshaping Cabot's global supply chain strategy, forcing them to rethink their local footprints, and the hyper-local flight to quality that is currently saving Brandywine from the commercial real estate crash, we have to ask a broader question.
Which is?
Are we entering a new economic era where the most successful businesses are no longer the largest or the most globally integrated? Are the true winners the ones that learn how to get smaller, more specialized, and fiercely local?
Wow. That is an incredible thought to leave on. The grimy industrial plant and the gleaming glass office tower playing by the exact same new rules of survival.
Yep.
Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, keep looking for the connections, and we will catch you next time.